Welcome to Multifamily Rockstars. If you are new to apartment investing or already experienced, you will enjoy this show. You will hear from the leading experts in multifamily real estate so that you can be a better owner, operator, and investor. Real people, real stories, life-changing. And now, your host, Ryan Christopher Nunes.
All right, so welcome. Jeremy Roll is with us today. He is a full-time passive cash flow investor in more than 70 opportunities across more than $1 billion worth of real estate and business assets. As founder and president of Roll Investment Group, Jeremy manages a group of over 1,000 investors who seek passive cash flowing investments in real estate and businesses. Jeremy is also the co-founder of For Investors by Investors, FIBI, the largest group of public real estate investor meetings in California, with over 30,000 members. Jeremy has an MBA from the Wharton School and is an advisor for Realty Mogul, the largest real estate crowdfunding website in the US. Jeremy welcomes emails to network with or help other investors and to discuss real estate or business investments of any size. Jeremy, really appreciate you taking your time with us today.
No problem. Thanks for having me on. Really appreciate it.
You know, I first heard about you when I was driving. I live in Houston, was driving up to Dallas and listened to some podcasts. And I was like, you know, it was such an amazing background that you have, because most people come in and they want to syndicate, and you had a totally different approach. You wanted to do things passively. So, and then when I heard you at the Old Capital podcast conference, I was really interested. I walked up to you, met with you, and was just interesting to hear your story and to learn about how deep you go in your analysis for passive investment. So really appreciate it again for you making time for our listeners.
Oh yeah, absolutely. I just hope that whatever we discussed today is helpful for whoever's listening. So
yeah, for sure. So yeah, let's get right into it. Why don't you walk us through your background, tell the listeners a little bit about yourself?
Sure. Thanks again for having me on. Appreciate it. So as Ryan mentioned, I am a full-time passive cash flow investor. I actually started investing in passive cash flow opportunities back in 2002 after the dot-com crash, for those of you who remember that, because I know it was a while ago. And really, the impetus for me was twofold. One was I did not like the volatility of the stock market. I'm a very kind of low-risk, slow and steady guy. So for having to watch the market go up and down 30% was just not a good fit for me in a year. But more importantly, actually, was a lack of predictability for my long-term, investments and retirement account. So when I started looking at alternative investments, my main focus was just trying to find more predictability. And what I kind of concluded was that kind of lower risk passive cash flow opportunities was probably the best fit for me for that predictability. So I started to dabble in this type of investing back in 2002 and eventually rolled all my money from stocks and bonds into passive cash flow over the course of several years. And in mid 2007, I had a last straw moment in the corporate world. I was actually working at Toyota headquarters at that time. And when I first went down this path, I did not do it to actually leave the corporate world. I did it to have the paycheck at the W-2 and to have the kind of more predictable cash flow on the retirement side. So just more predictable to build that up. But I decided to take a risk and leave the corporate world because I had enough cash flow built up to live off of. And so since mid 2007, I've been what I call like a full-time passive cash flow investor. But I've been investing in passive cash flow opportunities since early 2002.
Awesome. Well, that you definitely touched upon your how and why, and in terms of you're doing this passive. Why passive versus looking to sponsor deals, particularly with your Wharton background and so forth?
Yeah, no, good question. So it's funny, when I started, I was actually working at Disney headquarters in the corporate world, and my job was ridiculously busy. I mean, I remember I was working in a very large office building, and I would be in the elevator between floors on my cell phone in between meetings, calling people to get stuff done. And Disney wasn't even paying for my cell phone. It was like a personal cell phone at the time. And so to do something actively for me at the time, it just was not a fit for me. I didn't have the time or the bandwidth. And I started to go down the passive path almost out of necessity. And what I found is that I actually really like the passive path. So even right now today, like I have the potential or the time to go do something actively if I wanted to, but I love the concept of being passive, and for many reasons, including diversification across many different assets. I get to leverage people's time, money, credit, and experience. And the irony is that even though I'm invested across so many opportunities and so many different asset classes, like if somebody says, okay, Jeremy, you got to go be active on buying this multifamily deal or the self-storage deal or this mobile home park. I wouldn't even know how to do it. I know how to analyze it, I know how it works, but I can't execute on it. I don't know what a purchase and sale agreement looks like to buy a big building, and I don't know the specifics of it, right? But I do understand how to kind of vet an operator or sponsor, do underwriting on the deal, understand kind of the assumptions that have been made, understand maybe looking at the demographics and thinking a few years out to see is there still going to be demand for that asset. So I love the concept that I can actually make bets on many different people across many different geographies and different asset classes. And that's how I get diversified. And I love the concept of diversification, as you could tell. And I'm in over 70 opportunities right now. And I don't necessarily think that's the smartest strategy for most people. But for me, I just love the fact that I have that too. So that, if I were to go and become active, that's much harder to do, let alone the number of opportunities. But even just you're going to end up focusing on one asset class or maybe two, for example. So it just happens to be a better fit for me. It's not the right fit for some people for many reasons that we could talk about, but I have no problem giving up control. And I tell people that I feel like I give up control in exchange for diversification and to be able to leverage other people, knowledge and time.
No, that's a great point. I mean, obviously, it's probably not for everybody, but maybe you could just touch upon why, it might not be for everybody and why, I guess that control word is probably a key component of that.
Yeah, I would say so. I find that sometimes I have conversations with people who aren't sure which path they want to go down. And the first question that I ask them is like, are you comfortable giving up control? Because a lot of the time someone isn't comfortable getting, and there's nothing wrong with that. It's just not the right fit for their personality, where they're concerned about giving someone control over, how their money is being, how that property is being executed and the money they've actually invested. The other thing is some people like to invest only in a specific area with, let's say, what a 1 hour perimeter, so they can drive to and walk every property and just drive by any property they're invested in at any time. And they want that peace of mind. And that is very hard to do passively if you want to get diversified across a bunch of geographies and a bunch of asset classes, a bunch of operators in such a specific area. So, but in any event, you could do that actively very easily. You can go buy a bunch of single family homes, you could buy some apartments, you could do other things, and you can choose where you want them to be. So there's definitely a lot of consideration, and it's not the right fit for everyone, for sure.
Yeah. And so, obviously you've traded, the nice thing about having some passive cash flow coming in is that it does free up your time, like you alluded to. So how do you spend your time? What is your typical day like?
Yeah. So you would think that I live in LA and I'm just south of Beverly Hills, and you think I'm like at the beach, as soon as we get off this podcast, right? But the reality is that I am crazy busy, and there's a few reasons for it. Number one is that passive investing, if you want to keep your money working after a certain amount of time, you constantly have to reinvest it. You constantly have to look for new opportunities. And that's my literal full-time job, is finding opportunities for myself. And that involves networking with other fellow investors, networking with other sponsors or operators, and maybe even investor groups. And I have my own investor group, so that keeps me busy as well, but that's a secondary focus for me. But primarily, I'm networking with one of those three people all day long. And I've had the fortune to be able to build a large network surrounding it. So now I'm even busier because I just know more and more people. But if you really want to do this full time and you want to be properly diversified and you want to be able to reinvest your money over time, you're going to have to keep working at it. If I just stopped working for a year, I'd have plenty of cash flow, but I'd have a deficit in being able to reinvest and look at new things, and that'd be a problem.
And new opportunities to redeploy that capital.
Yes, which is specifically difficult right now. We're recording this in early 2020, and that's specifically challenging right now.
Yeah. What are the challenges that you face in deploying that capital?
Well, there's 1,000 ways to invest. And with my kind of more stabilized passive cash flow, I look for stuff that's stabilized, that, 80 to 100% occupied, may or may not have any value add upside. And I just want to go sleep tonight, wake up tomorrow, and not much has changed, because I live off the cash flow. So I want that predictability. Okay. So with that in mind, I'm not going into a deal where we're adding a lot of cushion or padding into it. So I've got to be particularly careful with the purchase price. And my opinion since early 2017 is that we're kind of at peak pricing across pretty much all asset classes on an average deal and an average price. So that is very challenging for someone like me right now. I went through the same thing between 05 and 08, and it was a long wait. It's a very agonizing long wait right now. There's still deals out there, and you have to kind of work even harder to find them where they're particular. I call them like no-brainers or unique pricing. With a big enough network, they can be found, but the volume is still much lower than I like it to be, obviously. So I've been sitting mostly on the sidelines since early 2017, been a much happier seller than buyer, been lobbying a lot of the operators I've invested with to sell. And I've actually been involved in over 25 sales in the last 2.5, 3 years. In fact, something else just closed last week. Something else is hopefully going to close next month. And this is the thing, right? So this money comes back and now you got to try and redeploy it. But right now I can't really redeploy it very easily. And that makes it even more challenging right now.
So how do you stay patient? I mean, I think it's really tough when the markets just aren't where you want them to be, to have that discipline and patience. So how do you do that? And especially when you have deals exiting and you might need to reinvest for tax purposes, depreciation, so forth.
Yeah, so different people have different personalities, and I'm one of those people where I have more cash than I like in the bank account right now, and I don't love it, but I'd still rather leave it in cash than to just kind of force myself to have every penny deployed. The truth is, on a spreadsheet, probably long-term, people who are constantly like making sure every penny is deployed are probably gonna do better than me. But I get to sleep a little better, I think, at night, knowing that I don't have to worry about getting at the wrong price right now and what that might mean for me in a year or 2 or 3 down the line. So one way that I keep myself really disciplined is I created a target as far as preferred return, cap rate, and cash flow targets at the beginning of a cycle. And I apply it to each asset class. Some of them are a lot similar, some of them vary a little bit. And then I kind of keep to the same target across the entire cycle. And what happens is that as the cycle goes on, some stuff gets too expensive. It can't hit those targets anymore. And I drop out of that asset class, except for the no-brainers. And I just keep going on the others. And what happened in this particular cycle is at the end of 2016, the last bastion, which was mobile home parks, kind of dropped out as far as hitting the criteria. And then I kind of been sitting on the sideline ever since. I still deploy, like I actually invested in 4 things in January, just to give you an idea. But
oh, wow.
Yeah, one of them was actually a follow-on investment to a previous fund I'd already invested in. But,
okay.
But so there's still stuff out there, but it's much lower volume that I'd like to see. And so anyway, so I keep myself disciplined by keeping my targets the same. And my plan is that once that we have an adjustment or a downturn eventually, because real estate's cyclical, I'm going to adjust my cap rate and cash flow targets to the new cycle, and then take it from there. But that keeping the same targets, I think, keeps me out of trouble essentially.
Got it. So
I think that's very, very helpful.
So very disciplined approach. So what are those targets on the cap rate, on the
Sure.
cash flow side?
So for those of you listening right now, especially if you're newer, like this might sound very unrealistic, but the reality is that this was completely realistic just a few years ago, right? So I have an 8% preferred return target minimum, which is very realistic right now. But I invest in Class B assets, and like an A- or B market. And the minimum cash flow going in net to investors has to be 9%. And I have a little bit of flexibility into 8.5, depending on how quickly it ramps up after. And then I targeted 11% average annualized cash flow over the whole period, which is, say, 10 years, which is typically what I target. So that's average annualized per year. That doesn't include the mortgage paid on some assumed depreciation. So that's not the total return. I focus mostly on the cash flow, and everything else kind of falls into line after that.
Okay.
So I can't really hit. I mean, if I want to go into a Class B, apartment building, where you live, then it's not going to be a 9% cash flow going in, and especially not if you're not doing an interest-only loan. So those are unrealistic numbers right now across all the asset classes, based off the multiples people are paying for the income right now, the cap rates.
Okay. And on the cap rate perspective, do you also have a target there?
I would say that it depends on the asset class. So my floor for a lot of the asset class has been about 7.5. I can get down to 7 in certain situations, but I start to get antsy below 7.5 and completely cut off below 7.
Okay. And that's multifamily as well.
Multifamily as well. I would say that's probably mobile home parks. I like to be over 7.5. Self-storage I could probably do in between. Senior living actually would be higher because the cap rates are still higher. So those are probably over 8. What else? Office and retail are also a little bit different. So each asset class is a little different, but those are kind of the floors that I like to set, where I just comfortable versus not, And to me, when you go through an entire cycle, what happens is that you see what was possible before. And the only difference now is that interest rates are lower, but people also are willing to pay a higher multiple, and not just because of interest rates. And so you realize, okay, well, I'm going to get myself into trouble if I'm not careful, because it's the same risk, and in some cases more risk in a way, for a lower return. And that's what really turns me off. And that's why the concept of, being fearful when others are greedy and being greedy when others are fearful can work very well. And it's for that reason. When people are greedy, they're taking the most risk for less return versus less risk for more return.
And so the last multifamily deal that you invested in was when?
Yeah. So the last multifamily deal I invested in was, I'm going to guess, in 2016 or 17.
Okay.
I'm pretty sure it wasn't 18. I'm pretty sure it wasn't 19. Yeah. And so anything for multifamily after 2013 had to have some unique pricing or aspect to it to me. Because of the run-up we had between 09 and 12 when people were getting foreclosed and they were needing some place to live. And so multifamily was really hot from an investor perspective. After 2012, I thought that was actually the first asset in this cycle that I thought got too challenging for me for cap rates. I've probably still invested in about 5 to 10 multifamily deals since then, but they've all been unique situations, unique stories, unique pricing. I can give you some examples, but they're all definitely unique.
Well, why don't you give us one example? One of the most unique ones. Yeah.
Well, I'm going to give you two examples, and I'll do them quickly, just because they're both so different, but they're both unique.
Okay.
So one was a preferred equity deal. Preferred equity has become a little more popular in the past few years. I'm not a fan of it generally, but I was able to get into a situation where an operator bought a building in 09, great timing, had an equity group come in and syndicated it. They had a right of refusal to actually purchase the building. They bought it for $9 million. They were able to, they bought it for, I actually don't know what the original price was, but they had the ability to buy it out at about $9.5 million in 5 years later, which was 2014 or 15 or something like this. I'll my dates are. And, but they couldn't flip it for a year. So the building appraised at 17 million when they bought it with the option at like $9.5 million.
Wow.
And what they did was they brought in prep equity for 1 year bridge, and they put 10% co-invest behind our money. And so the effective loan to value with all those valuations, that I was at about 50% effective loan to value, like equivalent, so to speak, as a preferred equity position at a 14% interest rate for a year. So when I tell you, I look for no-brainers, right? So that's an automatic, and not only that, they're own over $1 billion of real estate of multifamily. I've invested with them many times, and I knew them very well, right?
That's great.
So that just checks like every box as a no-brainer, right? Another example, same operator actually, was in 2015, Midland, Texas, which is an very heavy oil area. So it's a very volatile market. I wouldn't normally invest in it whatsoever for predictability, because it really varies depending on the price of oil. But this operator was able to buy a building, 300-unit building that was over 90% occupied, from a fund who needed to sell it off because the rest of their portfolio was institutional, so non-institutional in size, and they were motivated. And we bought it literally at 2009 pricing. And the reason why it was 2009 pricing was because oil was at below $30. And so it was the right time to be, greedy when other people were fearful. And we bought that, I think, for $18 million in 2015 and sold it last year for $34 million, maybe.
Wow. Fantastic.
Yeah. And it's purely time and play. Just said oil's at 30, or, we're catching it at this market at the right time. Right. And by the way, it was truly 2000, like you can run comps on a per door and look at that market in 2009 pricing. It was like 48 a door or something like that. So it was just another no-brainer, So yeah, anyway, those come along, but they're very unusual.
And it sounds like you have to be patient and disciplined to, for those opportunities. And like you said earlier, you have to get to know these people so that you get a look at when those.
The more networking you do, the more opportunities will come up. And so networking is key, and that's how these things surface, basically.
No, that sounds great. Well, appreciate that.
I just want to apologize for anybody watching. I'm having the sun shift through this window very slowly onto my face here. So sorry for all this light up here. Anyway, what are you going to do?
So, one question I think people will have is, you invested in Midland. It sounds like you're investing outside of California for sure. Yes. Do you go visit these places, or do you get to know the sponsors and there's trust, and you're not flying to Midland to do your due diligence on the asset?
No, I actually did fly to Midland.
Okay.
Yeah, I did actually. And actually I have a few oil investments in those areas, so I know the area anyway, but I did fly and look at the property. And I try to get to everything before I invest in it. It can't happen 100% of the time because of scheduling conflicts. One thing I don't do, though, is I don't typically fly out there and look at it myself. I have to get out there with the operator so I can get the operator's perspective, because they're going to understand it much better than me.
Okay.
I mean, they're the ones who decided it was the right thing to buy, and I need to get their perspective on why. So it's not nearly as productive for me to go out if I'm not going to go with the operator. So that depends on the asset class as to whether I can invest in something without seeing it in person. Some asset classes I can definitely do that. Apartments being a good example, because in the right infill area, you can kind of Google map, walk around. You can actually research competitors online very easily and get a sense for comps quite easily.
Sure.
Whereas something like self-storage or retail that requires a lot of drive-by traffic, you can look at traffic counts and get a sense, but it's often much better to be there in person to see exactly where
Okay.
it is. There was a property I invested in self-storage in Florida a few years ago with a top 25 operator. And it's funny because it was kind of, it's hard to describe. It was off of US 1 highway. And we actually had signage on the highway, digital signage. Like, that's fantastic, right? But the property was offset kind of far back, not the easiest to see for the drive-by traffic. And it was also not off a main road. You kind of have to like go back you have to go around and then around a side road in the back. So until you were there looking at it, you couldn't really just pull up maps and get a full sense. You could get a decent sense, but you can't get a full sense until you're there and see like how challenging or not challenging it is to how visible it is, for example. And
Sure.
Properties, retail properties, self-storage properties in particular, like the visibility is extremely important because the drive-by traffic is one of the biggest drivers of actual traffic. So it's very important in some
Interesting. That's interesting. So apartments typically, if you can get out to there with the operator, you'd like to do that, but Google Maps can suffice.
Yeah, and then every asset class and every location is going to be different too. I'd argue there are some apartments in the wrong location where you may need to go out and actually see what exactly is going on. But I feel like on average, it's going to be easier for me to be able to go take a look at an apartment building in person than it would be for a retail strip center or a self-storage property. Mobile home parks too. Mobile home parks, the challenge with those is that they're often in secondary markets, tertiary markets, and until you drive out and see exactly how far out it is from where everyone's working and actually like feel it, you don't get a sense to like, okay, what's going to be happening here? So there are some that are easier than others to do remotely.
Sure. And so, obviously you've been in 70 plus transactions. What lessons have you learned? What are the key takeaways for, potentially people investing passively, or even sponsors of how to communicate to investors like yourself?
So number one takeaway for sure is, there's a lot of takeaways, but the takeaway is that, I think that who you're making a bet on is even more important than the actual property itself. So, in other words, a sponsor, I think, is number one consideration, and then the property is a very close second. It's very important as well. But I think who you're making a bet on is so key. In that way they execute, how they handle challenging situations, how well they're going to market to the tenant base, how well they're going to retain the tenant base. There's a lot of things going on there. So that's number one. Number two is the documents. If you read between the lines, when you're trying to figure out who you're making a bet on, it can really be helpful and is a very important thing to do. And you could do that with a combination of looking at the documents and read between the lines. Is this person conservative or not? You can ask them questions and gauge if they sound like they're being conservative in the way they answer. There's a lot of kind of clues you have to look for that are a little tricky, but you kind of get used to looking for that. And of course, you can look at the assumptions and numbers to get a sense of that too, but it's not just about that. Number three is that, I would say that I would rather invest with the best operator with the worst marketing materials and, presentation than the worst operator with the best marketing materials and presentation. And that's something that actually took me a while to really understand and get used to. So when I started looking in 2002 and I was working in the corporate world and I worked at Disney headquarters, I have a Wharton MBA, I'm used to like delivering a buttoned up PowerPoint presentation in the conference room. And I started getting some of these offering documents and, some of them are nicer looking than others. And I started to kind of like discount or put aside some of the documents that didn't quite look as professional, but it could have been someone who had a ton of experience. And the next guy could just be really good with PowerPoints or whatever, but doesn't have nearly, it could be their first deal. So I think that it's important to consider that as well when you're looking at these opportunities and try and balance that out as well. We can keep going and there's a ton of learning.
You have a wealth of knowledge.
Yeah, there's another one I like, which I'd rather invest with a wealthier person than not if I have a choice. Because if there's a major challenge at a property, they have the financial ability to potentially help. So, for example, to avoid a cash call if there's a cash shortfall, to potentially get better terms on loans and interest rates because of their credit history and their net worth. There's a lot of positive aspects to that. That being said, what I've also learned is that even if you have the wealthiest person in the world, if they don't want to necessarily be helpful, they won't. So, they don't necessarily have to lend $100,000 to the company, even if they have, $100 million in the bank. That's a choice and not a requirement. So you've also got to make a bet on the right people, right? What I was talking about before. But all things being equal, a wealthier person can help to solve some problems that a less wealthy person can. That's a minor point, but an interesting one, So yeah, there's a lot of different things we can discuss.
Sure. No, that's, you've looked at a lot of transactions. You're probably sent, how many deals a week do you think you look at across, commercial real estate opportunities?
Every week is different. I don't have a number. I couldn't even answer. What I will say is that it's important to understand that what happens in this world is very random. And what I mean by that is that just because I got a cash out last week from an opportunity, it doesn't mean I can deploy it this week or I'm automatically going to be able to choose from 100 deals. Like there may be less this week and more next week, or less one month and more next month. What I can say though, for people who are newer, is that there is a bit of a seasonality to this, where in the summer, there's probably less opportunities you'll find between June and August, and then again between Thanksgiving and the New Year. So that's kind of a commonality. But besides that, finding opportunities is random, and that's part of the challenge. You cannot optimize this, right? If I know I have 3 sales happening in 4 months from now, I can find the 3 best opportunities right now and then can't get into them. And then all of a sudden I can go for months without finding the right thing next time, because that's when I got the cash. So this isn't a formulaic, and you can't put on a spreadsheet, say I'm going to do 6 deals this year necessarily. If you're trying to be really careful and picky, it doesn't work like that. And you have to kind of be okay with that too.
It's a little bit unpredictable.
Yes.
When the right sponsors are going to have the right opportunities that fit your criteria.
100%. Yeah. And then with the elections coming up in the second half of the year, I'm expecting it to be slower just by the nature of things.
The uncertainty.
Investors will be more concerned about deploying capital, not knowing what's going to happen, which party is going to be elected. Sponsors will probably assume the same thing, and so I'm expecting it to be slower.
When you look at the numbers and you see a presentation, where do your eyes gravitate towards? If someone shows you an underwriting model or
so I go through a few steps. So the first one, which is kind of the easiest thing for me to do very quickly, and the way that I invest in looking for that more stabilized cash flow is an easy metric. I look for the cap rate, and I immediately gravitate towards it and say, okay, does it even meet my criteria right now? In other words, am I comfortable with the multiple that we're paying for the property on the net operating income?
Okay.
And that easily puts most things into the trash for me right now, just with the current timing of the markets. Once I'm beyond that, I'll take a look at the investor structure. So I'll take a look at, does it have the preferred return that I need? And do I agree with the splits? Do I think they're fair? And do I think they make sense for the level of work and the experience that the operator has for this particular opportunity? And then after that, you can take a look at the other fees. So for example, is the management fee in line? Are there acquisition fees and other fees that actually line up to what I would expect to see, and they're not too much?
Okay.
Once I pass those kind of initial points, then I can dig into like the actual pro forma, take a look. I look at the cash flow per year. And so if just because I find something that has 9% year one, it doesn't mean it won't have 7% in year 2 for some odd reason. That would be unusual. But my point is that I look at every year and make sure it's ramping up and kind of what I need to see it at. And then I'll start to dig into it further from there. Looking at the assumptions, it's easy to look at the revenue and expense assumptions in terms of inflation, make sure they make sense. And then start to look at expense ratios, certain assumptions for other types of income, ancillary income that might be coming in. And you just keep going from there. Every asset class is different, but there's definitely a lot of similarities between them in general as well.
No, that's helpful, because I think a lot of people, they see deals and they want to be able to sift through things quickly, either spend more time or move on. So, kind of being disciplined, like you said there, and focused on what your goals and criteria are.
Yeah. And actually that's a good point. So like, if you ask me exactly what I'm trying to invest in, I have a very specific box that's very well defined. It actually helps a lot because it allows me to pass on a lot of opportunities that aren't the right fit for me. Even though they may look interesting, I may find 5 development deals that look really interesting in senior living this year, but that's not the right fit for me. It's not what I look for. So the more you can define your box, both in terms of your initial target and then your sub-target criteria, cash flow, et cetera, I think the better off you're going to be wasting less time.
One of the things that I remember you talking about is just, how in depth you go into the operating agreement. Maybe you could just spend a little bit of time, what things you look for, just for people that might not have a legal or background or desire to go that deep, but just things for them to look out for and just to be knowledgeable about.
Yeah. And I look for a lot of things. I'll kind of talk about some of the more common ones. And I think a very important thing to understand is that there could be a very big difference between what an operator tells you they're going to do and what they legally have to do in this document. Okay, so for those of you not familiar, the operating agreement is essentially, I'm not an attorney, but this is my understanding, is basically the rules of the company, right? And the rules that the investors have to follow and the rules the sponsor has to follow from a legal perspective on how the company is going to be run. And I've seen countless times where an operator says, you're going to get a quarterly report within 60 days of the close of the quarter. Okay. And then I look at their operating agreement and it literally says under reporting, the sponsor may provide reports from time to time, when they think it makes sense, or, I'm not using the right verbiage, but literally that's it.
Sure.
And then you go back to them and say, well, I thought you said you were going to send me quarterly reports. Forget the 60 days, right? I thought you said I'm going to get quarterly reports. Oh no, we're going to send you quarterly. Well, it doesn't say you have to do that. So you can never send me a quarterly report and I have no recourse, for example, right? Oh, by the way, you're going to send me quarterly distributions. I mean, a lot of these operating agreements say the sponsor will, at their own discretion from time to time, make cash flow distributions if they think there's excess cash flow to be distributed, beginning and end, right? So if I don't get a quarterly distribution if I don't get a distribution for 4 years, my only legal recourse would be to prove that they kept thinking it wasn't the right time to distribute any excess proceeds, right? So if the problem is that sometimes they have a lot of rules in their mind, but then they don't necessarily pay a lot of attention to the legal document their attorney's putting together, and it's not necessarily their fault. They just aren't that specific with the legal document. So I'll go in and actually try to negotiate some changes, and I'll look for stuff like the reporting requirements, the cash distribution requirements, cash call provisions. What happens if there's a cash call? Are there rules lined up to actually tell you what you're going to have to expect as an investor, right? A lot of the time, it's either really generic or not even stated at all. And so I'll come in and say, look, in fact, I have a very specific order I like to go in. If I have a choice, I'd say, can you make it so that you're going to call, we're going to do debt first. So in other words, if you need a cash call, ask the current investors to provide a loan. They'll be repaid so that you're not diluting people. Second step is to go for an outside loan, but mention a maximum interest rate they're allowed to actually do so they don't ask their cousin to give them a loan at 50% interest, right? Mm-hmm. And then third is equity internally. So if we're going to have to dilute, let's do it internally first. And the fourth would be outside equity, right? That's the order I personally like to go, and everyone can have their opinion. But the point is that if it doesn't say anything, they can go immediately and either take a 50% loan from their cousin, or they can go get a 50% equity interest from their cousin and dilute everybody immediately without even giving everybody the option of participating. Sure. So a lot of things, and like you can ask them what they'll do, but then it doesn't actually require them to do it in the rules. Sure. So I like to shore up the rules as much as possible, because if something goes wrong or something doesn't go quite as planned, at least you'll have the fallback of being able to point to the rules from a legal perspective.
Jeremy, do you have outside counsel or someone review these operating agreements on your behalf, or how do you get smart on those?
I don't. When I first started, I paid an attorney to look at a couple of deals, and I quickly realized I was going to the wrong type of attorney. They're a real estate attorney, so I went to a real estate attorney. What I didn't understand is that the better attorney to go to, I think, is someone who actually creates syndications on behalf of the sponsor, so they know exactly. Because the real estate attorney was like, "Oh, this is too risky. You're giving them all the control. Don't do it, beginning and end." And I'm like, no, this is actually purposely, I'm giving them control, And
that's my objective.
Right, exactly. So you want to take it to the right attorney if you want. You can do that to pay someone to review it and learn and see what they recommend is missing, because they'll really know well. I do not go to an attorney anymore because I started. It didn't take very long for me not to go to an attorney, because the operating agreements all have a lot of very common clauses, and once you get to learn them, it's really cookie cutter. I don't want to sound like law is easy, but it's literally like, between 10 and 13 sections. Normally they're all very similar across them. Sure. And most of them are going to contain most of the same things. So when you've read enough of them, you really know what to look for.
Sure. Now that's encouraging for folks. It's just, probably the initial hurdle, getting up to speed. And then once you've seen one, you've probably seen a dozen of them.
Yeah. And so I'll look for other stuff too. Indemnification clause, which legally, like if somebody does something wrong, where they get in trouble, and then you have to kind of look for specific words about, okay, well, what's excluded from that? Or like, okay, we agree that is willful misconduct, in there, is mismanagement in there, is fraud in there. Sometimes it is, sometimes it isn't. Every attorney doesn't like to put certain words in versus others. So you got to read the whole thing. It's really important to understand that document and read it through, even if you don't like looking at legal documents, because you're signing that you're going to abide by those rules and that you understand the rules and that you're okay with the manager agreeing to those rules. But you got to know what the rules are before you're okay with them.
Sure. No, absolutely. That's great. And then in terms of, I guess you've talked a lot about, what you do in terms of your goals and having a box, that you want your deals to fit inside, or deals that you want to invest in. Any advice for other passive investors, things to, I guess, how to go about this if they're looking to invest for the first time, or even seasoned passive investors?
Yeah. So especially for new people, number one is, if you're just trying to get your arms around this, think about or consider going with an asset class you understand best to start. So I think a lot of people tend to gravitate towards multifamily because they tend to understand it easier and better. They can relate to it than most other asset class. They probably lived in an apartment building at some point. If not, their friends have. They understand how it works, and it's actually a fairly easy business model, generally speaking. So compare that to running a self-storage or opportunity, or a senior, a assisted living facility. That's a whole different ballgame, right?
Sure.
So take the asset class that you understand best and start with that. Okay. And what I would suggest people do to really understand this is, especially if they're accredited, if you're an accredited investor, you can log on to the crowdfunding websites out there, and there's a lot of good ones. And you understand, though, that a lot of those websites act as intermediaries, so the returns will be a little bit lower potentially, in exchange for them finding and vetting and providing you with a list of opportunities. But if you want to, say you understand multifamily, you want to learn it, go onto the crowdfunding websites, download 20 multifamily deals tonight in your pajamas, and then put them all side by side and start to look at the similarities and the differences. I call it opportunity exposure, and it's really opportunity comparison as well. And that's how I learned. And so what you're going to find is that this deal's got no preferred return. The next 12 of them have an 8% preferred return, and one of them is a 7, and one of them is a 9% preferred return. And what happens is that you start to understand what is kind of market rate or fair for investors. You take a look at the profit splits. What's the variation on them? Take a look at some of the assumptions. What do people assume in terms of rent increases and inflation increases? And you're going to start to find those similarities, and you're going to start to find what stands out. And you're also going to learn different business models and strategies behind how someone is buying and operating, for what purpose, what's the whole business plan. So I recommend starting with one asset class to begin with and learn. Take the one you can relate to the most, so it'll be easiest for you.
Sure.
And take advantage of the fact that times are different than when I started. You can go and download all these opportunities. What I had to do that was go network in person for the most part to find 20 multifamily deals to compare them all. That literally was many months of work.
Sure.
Yeah.
Sure.
You could do this in an hour right now.
That's great advice.
Yeah,
as you're going through these operating agreements, how many questions and what due diligence do you do on those documents?
Yeah. So, the exact steps and everything that could be like an entire podcast. But what I will say is that probably on average, I ask maybe 100 to 250 questions, maybe 150 to 250, including the legal documents, which the legal documents on their own could easily be, I could be asking just about the operating agreement, 20, 30, 40 questions. It really varies by opportunity and how the documents are done and who made them. Sometimes the template's pretty good, and then maybe there'd be a little bit of questions, relatively speaking. But a lot of it is also, it's not just the legal documents, obviously. On the non-legal document side, a lot of it is just really getting a proper understanding of the business plan, the demographics, why the person really thinks it's a good opportunity. You may question some of the assumptions and the rents, or even I go line by line on the expenses, and some things I'll pick out and ask questions about. I can give you so many different examples. It's a lot of questions. And we talked about this actually offline, but sometimes I ask questions just to hear how somebody answers, so that I don't really care what the answer is, but I can gauge if they're concerned or not by asking a specific type of question. And so, they're not all necessarily designed for the purpose of the answer, but most of them are. Yeah,
that's great. Well, I appreciate that. It's amazing how thorough you are in your due diligence, and that's just great guidelines for people to make sure they know their sponsors and they know what they're investing in, because it's not monopoly money. These are real dollars.
Yes, I agree. It definitely helps that I'm generally a very thorough person. It's just my personality. So that's very helpful too as a starting point for sure. But I couldn't agree more. You're giving someone control. You've got to do all your due diligence up front. All the work I'm doing is up front, right? Ongoing, I'm reading a quarterly report, getting a check, and making sure nothing is crazy off versus what it was projected to be. So you've got to put the work in up front to make sure it's the right fit for you. You're going to have more than enough opportunities you can choose to invest in. And so if you're going to get down to the ones you like, you got to make sure they're the right fit. And it doesn't make sense to have any concern about an opportunity, just move on to the next one. So you've got to be thorough to figure out if that's really the right one for you, because there's so many of them out there.
Yeah, that's great advice. Really appreciate that, Jeremy. Thank you. On that, we had brushed upon in the intro is the for investors by investors. Maybe you could tell us a little bit about that, why you started it, what you do in that group, and
Sure. So For Investors by Investors is a nonprofit organization that I co-founded with one other person in 2007. And essentially, it culminated from the fact that between 2002 and 2007, I probably went to 2 to 3 networking meetings a week in Los Angeles. Back then, I had no kids, wasn't married. It was a lot easier. Well, I was married for most of that time. And but with the problem is that there's a lot of sales pitches. And what I would do is while I was in the corporate world, I would sit in the back row with some work, do 2 hours of work, wait until the end through a sales pitch so I can network with people, because typically networking sessions at the end where you have to sit through the sales pitch to listen to it. And not every meeting is a sales pitch, but there are a number of them. And some of them, honestly, like there's a big critical mass of people. It was worth sitting through 2 hours of sales pitch to network with 300 people, right? What happened is that when I left the corporate world and I went to one of these meetings the first time, I said, oh man, I don't have 2 hours of work to do. I have to listen to this now. And I don't want to sit here and listen to 2 hour sales pitch. So I realized I could just start my own meetings where the core foundation is that there is no sales pitch. And so I started that with one other person, and it grew organically over time. And it's become now the largest series of non-institutional real estate, public real estate meetings in California. We have over 30,000 registered users. We at our peak had about 13 meetings a month, most of which were in Los Angeles and in Orange County and San Diego. Now we probably have about 6 or 7 or so. And we have actually a few chapters out of state, but they're very random. I think we have one in Kansas City, possibly one in Denver, one in Chicago, and maybe 1 or 2 others. Our core foundation, there's no sales pitch. We actually try to break even on the cost of the venue and just keep the cost low. We actually lose money every year on it. But it's all about uniting investors, learning, and networking. And our meetings are typically either individual speaker format or a panel, multi-person panel format. And in California, anyway, the meetings typically have between 50 and 150 people who attend each month.
That's great. And so what's the content of the meetings? People come there, what do they hear about?
Yeah, so each chapter is different. So each chapter leader we don't take on chapter leaders, we know them for years. So we know to trust them on the no sales pitch and that we know they're an expert in real estate. And that's why actually we have a lot of dormant chapters. We're not looking to expand this. We're not looking to fill out a chapter and get it restarted. We're very careful who we take on. And so most of those chapter leaders, all those chapter leaders get to choose the format they want. What they'll do is they'll choose a topic for the meeting. So some of our meetings, for example, are single family, multifamily investing only. Some of them are all different asset classes of real estate. Some of them, we have one that's passive cash flow investors unite, which is mostly real estate, but it's just cash flow focused. And then every month there'll be a different topic. And some of the meetings, like I mentioned, are only individual speakers, and some of them are going to be panel discussions. And that's really up to the chapter lead to run them. The common thread is that they're all real estate based and that they are going to have no sales pitch. So if you're interested in any of them, you go to meetup.com and type in FIBI in the search box, like FIBI, or For Investors by Investors. And then it should show you the meeting closest to you by distance. And then you can click and see what type of meeting it is and look at the upcoming topics. Do not go to a meeting unless the topic is a good fit for you, for sure.
Well, appreciate that. Jeremy, this has been just a great conversation, and, you just have a wealth of knowledge, and we could go on for hours just unpacking all of your experiences, and really appreciate you making the time for us today. How can listeners get in touch with you?
Yeah, sure. No, and thanks for having me. I really hope this was helpful for people. So the easiest way to reach me, and don't hesitate to reach out to me, I'm happy to help any way that I can, is jroll, JROLL, at Roll Investments, ROLL, investments with an S.com. So jroll at rollinvestments.com is the best way to reach me.
Awesome. Well, Jeremy, thank you so much again. And, I hope listeners get as much out of this as I've gotten out of it. So really appreciate your time. And thanks for being so open with, all the advice that you can impart to people.
Oh, yeah, no problem. Thanks for having me on. Really appreciate it.
Thank you for listening to Multifamily Rockstars. We hope this episode was helpful for your personal and professional growth. For more episodes and to learn more about investing in multifamily apartments, check out lifechangingcapital.com.